Eastern Time, a risk modeling algorithm at State Farm headquarters quietly flagged 800,000 residential policies for immediate non-renewal. Within 48 hours, the contagion spread to all State Farmers and Liberty Mutual. This wasn't triggered by a new hurricane, a wildfire, or a flood. It was triggered by a reinsurance capital call from Switzerland that most homeowners don't even know exists. For the next 60 days, millions of American families will open their mailboxes to find a letter that effectively puts them in technical default on their mortgages. The clock started on Monday, the cancellation notices are already in the mail, and the banking system is quietly preparing for a liquidity crisis that looks nothing like 2008, but is mathematically far more dangerous. Here is what you need to understand. This is not about bad weather. If you think your insurance went up because of climate change, you are looking at the decoy. This is about a mathematical trap set by the global reinsurance market, the massive shadow banks in Munich and Zurich that insure the insurance companies. They have activated a solvency tripwire buried in the underwriting guidelines of Fannie Mae and Freddie Mac that nobody paid attention to for 40 years. Now, the US housing market is caught in a position it mathematically cannot escape. The invisible tripwire sits exactly at a combined ratio of 115%. Let me show you why that number matters more than your interest rate, your credit score, or your home equity right now. Back in 2022, major insurers realized that for every $1 they collected in premiums, they were paying out $1.15 in claims and operational expenses. They were bleeding cash on every single policy they wrote. In any other business, you would just raise prices, but insurance is highly regulated. State insurance commissioners blocked rate hikes to keep voters happy. So, the insurers triggered a nuclear option known as market retreat. You can find the consequences of this buried in the Fannie Mae selling guide, specifically section B73. The language reads like a legal sedative, but the implications are terrifying. It states clearly, the borrower must maintain property insurance. Failure to do so constitutes a default under the mortgage deed. Translation for normal humans: if your insurance company drops you, and you cannot find a new policy within 30 days, your bank doesn't just say, "That's too bad." They are legally required to force-place a policy on you. This isn't normal insurance. It is force-placed coverage, designed only to protect the bank's money, not your home, and it costs 400% to 1,000% more than what you are paying today. Or they can exercise their right to call the loan due immediately. Why is this happening right now? Because the reinsurance wall just hit. Reinsurers just raised their capital retention requirements by 40% for the 2026 fiscal year. This forces local insurers to dump risky policies instantly to avoid their own bankruptcy. They aren't dropping you because they hate you. They are dropping you because their own math says you are a liability they can no longer afford to carry. Let's look at the math that created this uninsurable era. The average American mortgage payment is currently hovering around $2,100. The average insurance premium used to be a manageable $150 a month. But in states like Florida, California, and now surprisingly in the Midwest due to hail risks, premiums are jumping to $800, $1,000, or even $1,000 to $500 a month. When you add that new cost to the mortgage, the borrower's debt-to-income, DTI ratio, explodes past 50%. The bank's computer sees this new DTI and flags the loan as high risk. This traps the homeowner in a way we have never seen before. You can't sell the house because buyers can't get insurance to close the loan. You can't stay because you can't afford the new escrow payment. You are a prisoner in your own asset. This is creating a phenomenon I call the escrow shockwave. Most people don't pay their insurance directly. It's wrapped into their mortgage payment. When the premium doubles, the bank pays it, but then they send you a letter stating you have an escrow shortage. They don't just raise your payment to cover next year, they raise it to pay back the shortage from last year. Suddenly, a family's housing cost jumps by $700 a month overnight. That is the breaking point. We are seeing delinquency rates spike not because people lost their jobs, but because the carrying cost of the house has fundamentally changed. Now let's talk about the institutions currently trapped in this feedback loop. It's not just the homeowners, it's the banks holding the paper. Wells Fargo, Chase, and Bank of America hold trillions in mortgages that are backed by physical collateral, your house. The entire mortgage system is built on the assumption that if you stop paying, they can take the house and sell it. But if that collateral becomes uninsurable, the value of the asset on the bank's books drops to near zero. A house you cannot insure is a house you cannot finance. And a house you cannot finance is worth cash value only. That represents a 40% to 60% immediate haircut on home values in affected zones. The banks are sitting on a time bomb of unsecured collateral, and they know it. For 3 years, the government tried to contain this through state-backed insurers of last resort, like Citizens Property Insurance in Florida or the FAIR Plan in California. It was a Ponzi scheme of subsidized risk. They pretended that the state could cover the losses if the private market walked away. But here is the data point they are hiding. These state plans are now technically insolvent. Citizens' property insurance is leveraged 8-to-1. If a major Category 4 storm hits Miami, or a major fire complex hits the Los Angeles Hills in 2026, the state plan goes bankrupt. And here is the kicker. When the state plan fails, they have the authority to levy emergency assessments on every single policyholder in the state. Even if you don't have citizens insurance, even if you just have auto insurance, you will be taxed to bail them out. It is a hidden tax on the entire population. This brings us to the logic trap and the impossible choice facing 14 million homeowners right now. Option A is to pay the force-placed insurance premium. This is the insurance the lender buys for you when your policy lapses. It has zero liability coverage, zero contents coverage, and costs 10 times as much. This pushes the average family into an immediate monthly deficit. You burn through your savings trying to keep the house, only to eventually default anyway. It is a slow bleed that ends in foreclosure. Option B is to go naked to self-insure. This is the fantasy of the libertarians. They think, I'll just pay off my mortgage and drop the insurance. But 64% of American homes have a mortgage. The bank will not allow you to go naked. It triggers a legal process known as non-monetary default. Even if you make your mortgage payments on time, failure to maintain insurance is a breach of contract. They can, and they will, foreclose on a performing loan to protect their assets. And even if you own the home cash-free, going naked means one fire, one lawsuit, one storm wipes out your entire net worth. It is financial suicide. Option C is to sell the house immediately. This creates a fire sale dynamic. Imagine 10 neighbors on the same street receive non-renewal notices in the same week. They all panic and list their homes. Inventory spikes. But who buys the house? A retail buyer needs a mortgage. To get a mortgage, they need insurance. If State Farm won't write a policy for you, they certainly won't write one for the new buyer. The deal falls through at closing. We are seeing this happen in real time in Louisiana and parts of California. The only buyers left are cash investors, institutional giants like BlackRock, Vanguard, or private equity firms, who offer 50 cents on the dollar because they can self-insure across a massive portfolio. This is the greatest transfer of wealth from the middle class to Wall Street since 2008. And it is happening through the mechanism of insurance. We need to look at the Midwest because everyone thinks this is just a coastal problem. It is not. The fastest rising insurance rates in 2025 were not in Florida. They were in Minnesota, Arkansas, and Nebraska. Why? Convective storms. Hail. The cost of repairing a roof has tripled due to inflation and labor shortages. Reinsurers have decided that the American Midwest is a high-frequency loss zone. They are pulling out of the heartland. This means the crisis is national. If you live in a suburb of Minneapolis or a town in Ohio, you are just as exposed to this kill switch as someone on the beach in Miami. The algorithm doesn't care about the view. It cares about the replacement cost. Let me explain the reinsurance spiral so you understand why this won't get better in 2026. Reinsurance is a global market. The capital comes from sovereign wealth funds, pension funds, and institutional investors who want a return on their money. In 2024 and 2025, they lost billions on secondary perils, things like flash floods and hailstorms. So they changed the rules. They raised the attachment point. This is the deductible the local insurance company has to pay before the reinsurance kicks in. It used to be $100 million, now it might be $500 million. This means the local insurance companies, the ones you pay, are now on the hook for all the smaller storms. They don't have the capital for that. So their only choice is to cancel your policy to reduce their exposure. This leads us to the shadow inventory problem. Banks are currently delaying foreclosures on uninsurable homes because they don't want to realize the loss. If they foreclose, they have to take the house onto their books. Then they have to pay the insurance and taxes. They don't want it. So we have zombie properties, homes where the borrower hasn't paid in 2 years, but the bank hasn't moved to evict. This artificially keeps supply low and prices high, but eventually the regulators force the banks to clean up their balance sheets. When that dam breaks, likely in mid-2026, a flood of distressed inventory hits the market, crashing prices in these high-risk zones. So here is where we are entering 2026. The insurance kill switch has activated. The private market is fleeing. The state plans are insolvent, and the banks are quietly preparing for a wave of technical defaults. This isn't just about inflation anymore. It represents the definancialization of American housing. The asset class that built the middle class, the 30-year fixed mortgage, is becoming obsolete because the underlying insurance contract is broken. You cannot have a 30-year loan on an asset with a 1-year renewable insurance policy that might be cancelled next month. The mismatch is destroying the system. I want you to think about what happens when your home is no longer an asset, but a liability. For 50 years, the strategy was buy a home, build equity, retire. That strategy assumes the carrying cost remains stable. They are no longer stable. We are moving toward a rentership society, not by choice, but by actuarial force. If you cannot insure it, you will eventually sell it to someone who can. And that someone is a corporation, not a family. This is the end game of the current crisis. Yes. In the next minute, I need you to listen closely because there are specific steps you must take to protect your equity before the letter arrives. If you live in a coastal state, a wildfire zone, or even a hail belt in the Midwest, you need to check your mailbox. Do not ignore the notice of policy change. If you lose coverage, you have less than 30 days to act before the bank steps in. The window to protect your equity is closing. You need to know which insurers are still solvent. You need to know how to structure your deductible to make the premium survivable. And most importantly, you need to know how to negotiate with your lender before the force-placed policy kicks in. I have spent the last 3 months analysing the solvency ratios of every major carrier in the US. I have put together a breakdown of the safe zones for 2026, the areas where insurance is still stable, and the specific defense strategy to use if you receive a non-renewal letter. There are loopholes in the forced place regulations that you can use to buy time, but the banks will never tell you about them. You need to know how to challenge the replacement cost valuation to lower your premiums legally. I have compiled all of this into a comprehensive, uninsurable guide. It includes the scripts to use with your insurance agent, the list of solvent carriers by state, and the step-by-step process to fight a force-placed policy. Do not wait for the cancellation letter to arrive to start looking for a parachute. The system is rigged to strip your equity the moment you become distressed. Click the link in my bio or go to the website on the screen to download the full guide right now. Educate yourself before the algorithm flags your address. The best time to fix this was yesterday. The second best time is right now.